Hello investors, welcome to Simpli Stocks. Today we will be discussing four small cap stocks that have announced good results. The result season is about to end, so this will be our fourth and final video of this series. The stocks which we will be discussing today are special because not only they have announced good results, but at the same time they are trading at attractive valuations also right now. And if you are new to our channel or you have missed the last three videos, I will add their links for you in the description below. You can watch them from there. So let's get started right away without any delay. And yes, as a standard disclaimer, none of these stocks are buy or sell recommendations. So please keep that in mind. So the first stock we will study is Pokarna. Pokarna is in a way a construction stock. It is in the business of manufacturing and exporting quartz surfaces. Quartz is a type of stone, and quartz surfaces, as you can see on my screen, are these premium looking slabs that are used in expensive homes, hotels, offices, pubs and bars, etc. Pokarna has more than 10 quarries in India from where it extracts quartz. Then at its manufacturing plants, this quartz is processed to make these surfaces. Now see, India and the USA are Pokarna's two biggest markets. That's why when all this Trump tariffs drama happened, Pokarna's stock was a bit volatile. Things have definitely improved since then, but some uncertainty is still there. And just a few days ago, Trump imposed heavy tariffs on aluminium and steel, which are two essential construction materials. So that's a risk you'll have to track in Pokarna, because even if there are no direct tariffs on India or on these quartz surfaces, the US construction sector can still see a slowdown due to other tariffs. Now, let's look at the results. In FY25, Pokarna's sales have increased by 35% to 930 crore rupees. Its profit has more than doubled, jumping from 87 crore to 188 crore rupees in just 1 year. And at the same time, you will notice the EBITDA margin has also increased from 32% to 37%. And the management is saying that going forward, they will be able to maintain at least 35% EBITDA margin. Now, Pokarna has been working on two premium product lines, Chromia and Krios. These both will start bringing good sales growth and margins for the company from this year. Now, as you can see here, in Q4, that is from January to March months, Pokarna sales grew by 63% compared to the last year, while net profit has quadrupled or become 4x. And the reason for such high sales growth is that a lot of pre-buying has happened in US due to these tariffs. Pre-buying as in, since tariffs were about to be implemented, Pokarna's customers purchased and imported large quantities of quartz surfaces in advance, so they wouldn't have to pay higher prices later. That's why in Q1, that is from April to June months this year, sales growth might be slightly lower because all that pre-buying has happened. But overall, Pokarna is a good business growing at 25 to 30% rate that you can check out. Now, because of this tariff related uncertainty, the management has not given any guidance or estimate for sales this year. But if you look at the sales growth of last 4 years, the CAGR is above 30% and profit growth too has been above 15% CAGR. The stock is currently trading at a PE of 18, and even if we exclude the extra sales and profits due to pre-buying, the PE would be still below 25. Plus the business is growing at 25 to 30% rate annually. Now the second business we will study is Elecon Engineering Company. It is an engineering capital goods business, meaning its products are used across many other industries. Elecon has two business segments, gear and material handling equipment. Now, in such industries or machines where there is any type of rotating or spinning movement, gears are used. Like if you can see here, Elecon makes various types of gearboxes for cement, sugar, steel, marine, rubber, and similar sectors. Apart from this, they also make material handling equipment, basically those machines which are used to lift or move heavy objects or material. For example, Elecon manufactures large weighing machines, wagon tipplers which are used to unload goods from railway wagons, pulleys, cranes which are used at ports, and other loading equipment. And Elecon supplies these material handling machines to steel, mining, fertilizers, port, power, etc., or basically any sector that deals with heavy products. And accordingly, you will notice that they have similar client base. So Elecon has Adani Group as customer, NTPC and BHEL in power, Cochin Shipyard in marine, SAIL and ArcelorMittal in steel sector, and so on. Now focus here. The gear segment is Elecon's bigger segment. About 80% of its sales come from there, but growth is lower in that segment. Whereas the MHE segment, which brings 20% of the business, has seen 73% sales growth in just 1 year. This is because strong demand from steel and power sectors for these machines. And you will notice that on the brighter side, their gear business is also recovering. Gear division sales grew only 5.5% last year, but the order book for this year has expanded by 9%. That's a good sign. And the MHE division's order book has grown by 40%, taking the total order book up 19% to almost 950 crore rupees. And going forward, the management is projecting similar 19% sales growth for this year. That is FY26, which is again a very good sign, because you see here, Elecon sales grew 15% last year. And now for this year, management is guiding 19% growth. That means the growth rate, that is the speed at which company is growing, is increasing. First it was 15% and now it is 19% because the company has received many new orders. EBITDA margin has remained stable around 24.5%, while the net profit has increased by 17%. Finally, let us take a quick look at the valuations. So as you know, the order book grew by 19% and management is estimating around 2,650 crore rupees in sales for this year. Along with that, they have said that EBITDA margins will remain stable around 24%. So in that case, Elecon sales and profit growth for this year can be around 18 to 20%. Based on that, Elecon's 1 year forward PE on estimated profits of FY26 comes out to roughly 30. So Elecon is also a good business that you can study on your own. And since GDP growth is picking up again post elections, so Elecon can benefit from that too. But here also there is some tariff related risk. So that's something you'll have to keep tracking. Now look, today's Elecon stock is doing well because results have been good. But whether it will continue to do well after 3 months or not, we don't know. That we will have to see when its results come out again. Many people don't accept this, but all this long-term investing and such is a lie. Retail investors keep singing the songs of long-term investing and continue to hold on to terrible stocks that are performing poorly. Let me ask you something, okay? You will hold a stock for the long term only when it continues to give good results every quarter, every year, right? Besides, for the namesake, there have been long-term investors of Idea and Reliance Power too. You know what happened to both these stocks. So if you have a large portfolio or if you are a serious investor, then you can't be lazy. You will have to check your portfolio every 3 months. You will need to cut bad stocks and you have to increase the stake in the ones which are doing good. So that's why we have created a personal WhatsApp community for serious investors where we closely track more than 100 good quality stocks. We cover their business models, valuation, risk factors, how their results have been, everything in detail. Here I also share my portfolio and I am there to clear all your doubts on one-to-one level. But yes, we do not provide any buy or sell calls on any stock. We are not SEBI registered. My job, as I see it, is only to provide you with correct and complete information on stocks. If you are interested, then you can send me a WhatsApp message on this number. Otherwise, we have also given a link in the description. You can message us using that link. And remember, this is a paid community with a monthly fee of just 850 rupees. Meaning for just 850 rupees per month, you are getting to know about so many good quality stocks. And yes, there are two plans, 6,000 rupees for 6 months and 10,000 rupees for a full year. In the 6-month plan, your per month cost will be 1,000 rupees. And in the annual plan, your per month cost will be just 850 rupees. If you are interested, you can contact us using the link below and you can join the community. Let us come back to our stocks. At number 3 is a very interesting business, and surprisingly, not just one but actually two ace investors also hold this stock in their portfolios. The stock's name is SG Finserve and Madhusudan Kela holds 1.7% stake while Ashish Kacholia holds 1.1% stake in it. SG Finserve is an NBFC and it is into dealer financing, vendor financing and bill discounting. Don't get confused or overwhelmed by all this. It is a very unique business and trust me, you will understand it in just a minute. Just listen to me. So suppose you are a small business or an MSME and you supply an auto part to Tata Motors. Now whatever goods you have sold, Tata Motors will pay you for them after 30 to 45 days. But you are not a big businessman who has unlimited money lying around, right? You need cash to buy new inventory so you can continue selling, so you can continue doing your business. In such a case, you will go to SG. Now, SG knows that your customer is Tata Motors and Tata is definitely going to pay you. They are not going to shut their shop and run away. So, SG Finserve will give you a loan. And when you receive your payment from Tata Motors after 30-35 days, you will pay back the loan to SG. This is how SG Finserve finances the suppliers of large companies. If you see here, they work with suppliers and dealers of many famous companies like APL Apollo, Bajaj Electricals, Pata, Polycab, Tata Steel, and Vedanta. And because of their model, there are no NPAs or loan defaults. So, as a business model, SG Finserve has a lot of scope in India. And as India will grow, industries and manufacturing will expand, and the demand for this kind of service will also increase accordingly. And SG's base is so small, meaning it is such a small company that it can continue to grow fast. Now, I have told you all the good things about SG so far, but yes, there have been some issues in the business as well. What happened was that last year the RBI brought some rules. Because of that, SG had to reduce their business size by half. They had to cut the whole loan book by half. Like if you see here, from January to September last year, their AUM, interest income, and net profit, all three major metrics declined. But then in the last 6 months, SG has shown very strong recovery and the business has surpassed even beyond previous levels. Finally, let us talk about the results now. So you will see here that their AUM has gone up by 39 to 40% in a year to more than 2,300 crore rupees. AUM or loan book is basically the money that an NBFC or a bank uses to give out loans. Even quarter on quarter, a solid 48% recovery is visible. Similarly, disbursements, meaning the amount of new loans, that figure has increased by 9% compared to the previous quarter, and the total income has grown by 33%. So we can say that after the downfall of 3 quarters, all those 9 months, SG has once again gained momentum, and that too quite strongly. Lastly, let us take a quick look at this chart which tells us their future guidance. As I mentioned earlier, their AUM is now more than 2,300 crore rupees. Just as we look at sales growth in other companies, in NBFCs, we have to look at AUM growth. So SG's management is targeting 4,000 crore rupees in AUM for this year, that is FY26. And their target is to grow their loan book to 6,000 crore rupees by FY27. That translates into a massive 60% CAGR growth for the next 2 years. And as growth will come, margins and return ratios will also improve. So SG Finserve is also a unique, fast-growing business that you can analyze yourself once. Now, the fourth and final business that we have on our list is Nuvama Wealth Management. This has been part of my portfolio for the past 1 year, and it has also delivered very good results. And especially because no one expected Nuvama to report such a strong results, because Nuvama's business is around the stock market and market had corrected. So we will now talk about the results and business together. It will be easier that way. So Nuvama offers a variety of services related to the stock market, investments, etc. It has four businesses: wealth management, asset services, asset management, and capital markets. Their wealth management business has grown 20% year on year in fourth quarter, and also 20% if we talk about the whole FY25. In this business, they offer investment management, estate planning, and wealth management services to millionaires and multimillionaires. The second major segment is capital markets, where they help companies to launch their IPOs. They help in fundraising, etc. This business has grown 59% year on year in FY25, but only 16% in Q4. The growth has slowed down due to the market correction, because when the market corrected, the frequency of IPOs also reduced. Now, the most unique development in Nuvama is its asset services business. This business has doubled in a year, and in Q4, the growth has been tremendous, around 85%. Asset services includes their custodian business. Now, what is custodian business? So, in this business, Nuvama safely holds the money of FIIs and DIIs, and it then also executes all their transactions on their behalf. For this, Nuvama charges a fee. This business has grown very well, which is why Nuvama's Q4 and full year results have been very strong. Lastly, there is a small segment called asset management, where they run mutual funds and investment funds. That business saw 17 to 20% growth. So overall in in Q4, sales grew by 29% and in FY25 by 41%. Operating net profit has gone up by impressive 65% for full year and 41% in Q4. And ROE has jumped from 24% to impressive 31.5%. And since the results are out, Nuvama's stock has rallied well. But even now, the business is trading at a PE of less than 30. Plus, the growth is strong. And at the same time, the nature of the business, especially in wealth management and asset services, is such that clients stay for a long time. There is a stickiness in the business. So, sales and profit show less volatility. This is an advantage in Nuvama's business model. Besides this, the stock market and wealth management segments are already seeing good growth in India. If you look here, over the last 5 years, FII money has grown at 24% CAGR. Similarly, assets under custody of hedge funds and PMS have grown at 50% CAGR. Additionally, the number of HNIs and ultra HNIs in India are rising rapidly. Because of that, it is estimated that the wealth management market will triple in the next 5 years, and the alternative investment market, that is investments beyond the stock market, that market will grow 5x in the next 10 years. Now, you might find Nuvama a little bit difficult to understand, but it is a good, fast-growing business that you should still consider studying once. Now, if you have liked these stocks, make sure you smash the like button, and also you can subscribe to our channel, Simpli Stocks. You see, we are working so hard to bring this content to you for free. Your likes and subscriptions are our only motivation. You can definitely do at least this much for us. So don't forget to like the video and subscribe to our channel. I'll see you in the next video. Happy investing.